Hello, and welcome to Team 4's Project 6 presentation on global money supply. Money supply or money stock can be defined as the total amount of money available in an economy at a particular point in time. 4 countries make up 75% of the total money in circulation globally.
Based on data of currency in circulation, it is estimated that global quantities of money are increasing in an accelerating fashion. In 1990, the total amount of currency in circulation passed $1 trillion. 12 years later, the total amount doubled. Less than 6 years later, in early 2008, the amount doubled again. While there may be a continual lowering of asset prices, the substantial increases to the money supply will lead to continuing higher prices for consumer goods. This can lead to a view that both inflation and deflation are occurring simultaneously. Determining inflation or deflation has primarily been based on the increase or decrease of the money supply. Of the 4 countries that account for the majority of global currency circulation, the US dollar and European Union euro contribute to more than half of this total amount.
The history of the United States money supply began in 1913 when the Federal Reserve was established. Starting in 1914, there have been 3 major price inflations. Each of these price inflations have been accompanied by a corresponding increase in the rate of growth of the money supply. An acceleration of the money supply growth in excess of real output growth has consistently produced inflation. Economists explain these movements by changes in price expectations as well as by changes in interest rates that make money holding more or less expensive. For all of the major inflation occurrences, the economy decline in each downturn was generated by the reduction in the quantity of money. This is especially true for the first major price inflation that occurred during the Great Depression.
For the United States, M1 consists of types of money commonly used for payment, such as currency and checking account balances. M2 includes M1, plus balances that generally are similar to transaction accounts and that can be converted readily to M1 with little or no loss of principal. In the past, M3 included M2 plus certain accounts that are held by entities other than individuals and are issued by banks and thrift institutions to augment M2 type balances in meeting credit demands. It also included balances in money market mutual funds held by institutional investors. Since 2006, the U.S. Federal Reserve no longer publishes M3 aggregates. Overall, the amount of U.S. currency in circulation continues to increase.
A monetary union is also known as a currency union or a common currency area. It involves multiple countries ceding control over the supply of money to a common authority. The European Union was formally established as a monetary union in 1993. Adjusting the money supply is a common tool for managing overall economic activity in a country. Changes in the money supply also affect the financing of government budgets. Now this sets new limitations on a country's economic policies from giving up the control of a nation's money supply. As of 2007, there are 27 different European countries that are part of the European Union and use the euro currency. Why would a country want to change their currency? There are generally 2 main reasons a country might want to switch to a new currency. The first is tied to cost. The cost of switching to a new system is much higher than for a typically fixed exchange rate regimen, giving people more confidence that the system will last. The second reason is the monetary union eliminates the transaction costs incurred from exchange currencies in international transactions.
The European Union defines M1 aggregate as the total currency in circulation plus overnight deposits. M2 includes M1 plus deposits with an agreed maturity up to 2 years and deposits redeemable at a period of notice up to 3 months. M3 is still published by the European Central Bank and is made up from M2 plus repurchase agreements, money market fund shares in units, and debt securities up to 2 years. Similar to the United States, the European Union has suffered financial crisis. The amount in bailout and rescue funds is about $1.4 trillion. This is also a trend for the euro in terms of the quantity of money supply and circulation, which is increasing each year.
By comparing the growth of M2 aggregates for the dollar and the euro over a decade, it is evident that the euro is increasing in quantities faster than that of the dollar. This can lead to an increase in prices and a loss of purchasing power for customers. which can also be considered inflation. To forecast inflation potential, in the past, the U.S. has used its M2 figures to calculate the likelihood of this happening. This was a fairly effective process in the past until the euro passed the dollar as the largest currency in circulation. Whether or not inflation will now occur is difficult to determine since the money supply is less and less relevant in relation to its control.
In summary, the United States has suffered many forms of inflation in the past, which can be tied to the quantity of the money supply. Currently, the U.S. is again facing the possibility of inflation. Globally, other countries and their currencies, like that of the European Union's euro, are also experiencing a similar financial crisis. Historically, the U.S. has decreased its money supply to bounce back from these price inflations. The current threat of inflation to the U.S. has been combated with the government buying back Treasury bonds. The hope is that this will stimulate the economy and ward off inflation. This action is a way to buy back debt to fund spending and maintain low interest rates that should keep the rate of inflation low. By purchasing bonds, the U.S. is responding to the inflation threat by decreasing the money supply. Based on what happened during the first major price inflation in the late 1920s, it is our recommendation that the money supply be held stable. With the increase in the money supply, the U.S. faces high rates of inflation, and decreasing the money supply too much may cause a recession that can take decades to overcome.